The story of the Indian stock market begins in the 19th century. India was under British rule and economic activity was increasing. This led to the need for a formal system to trade shares. This marked the beginning of stock trading in India. Transactions took place informally, with traders gathering near Bombay's town hall. This was the precursor to a more structured exchange. The seeds of a financial revolution were sown. These early gatherings laid the groundwork for India's future financial hub. The informal nature had its limitations. A need for a regulated platform was apparent. This led to the formation of the Bombay Stock Exchange, BSE, in 1875. India's financial landscape was forever changed. The establishment of the Bombay Stock Exchange, BSE, was a pivotal moment. It marked the birth of organized stock trading in India. The BSE quickly became a hub for investors and companies. It provided a platform for raising capital and trading shares. The early years of the BSE saw modest growth, with a limited number of companies listed on the exchange. Trading volumes were relatively small. However, the BSE laid a solid foundation for the future. The years leading up to India's independence were significant. The BSE witnessed increased activity. World War II impacted global trade, and this had a ripple effect on the Indian stock market. The BSE navigated these challenges and emerged as a resilient institution. India gained independence in 1947. The country adopted a socialist economic model. This model emphasized state control and regulation. It had a profound impact on the stock market. The government's focus was on public sector enterprises, and private sector participation in the market was limited. The socialist policies presented challenges. Growth in the stock market was restricted, and public participation remained low. The government recognized the need for change and introduced policies to encourage private investment. The stock market faced several issues during this period. Liquidity was low, and transparency was lacking. These factors hindered the market's growth. The 1990s began with a major event. The Harshad Mehta scam shook the Indian stock market. Mehta, a stockbroker, exploited loopholes in the banking system. He manipulated stock prices, causing a massive surge and subsequent crash. The scam exposed vulnerabilities in the Indian financial system. It highlighted the lack of regulation and oversight. The scam led to significant reforms in the stock market. The Harshad Mehta scam was a turning point. It forced the government to rethink its approach to market regulation. The Securities and Exchange Board of India, SEBI, was given more power. This was crucial to prevent future scams. Liberalization's dawn reforms reshaped the market. The 1991 economic reforms marked a paradigm shift. India embraced liberalization, privatization, and globalization. These reforms had a profound impact on the Indian stock market. The reforms opened up the economy to foreign investment. The liberalization of the Indian economy was a watershed moment. It led to increased participation from foreign institutional investors, or FIIs. The influx of foreign capital brought much-needed liquidity to the market. The reforms also led to the establishment of the National Stock Exchange, or NSE, in 1992. The NSE introduced electronic trading in India. This revolutionized the way stocks were traded. The NSE's modern infrastructure and transparent trading practices made it a popular choice for investors. The rise of the NSE competition and growth. The entry of the NSE brought competition to the Indian stock market. This competition between the BSE and NSE benefited investors. It led to lower transaction costs and improved efficiency. The NSE's focus on technology gave it an edge. The NSE quickly gained market share. It became the largest stock exchange in India. The competition between the two exchanges drove innovation. It resulted in a wider range of financial products and services for investors. The growth of the NSE transformed the Indian stock market. It made the market more accessible to retail investors. The NSE's nationwide presence expanded the reach of the stock market. SEBI takes the stage. A watchdog for the markets. The Securities and Exchange Board of India, or SEBI, played a crucial role. It strengthened regulations and improved corporate governance. SEBI's efforts aim to protect investors and ensure market integrity. SEBI introduced several measures to enhance transparency. It mandated stricter disclosure norms for listed companies. This helped investors make informed decisions. SEBI also played an active role in investor education. The regulator's proactive approach helped restore confidence in the market. SEBI's efforts have been instrumental in the development of the Indian stock market. Its role as a regulator is critical for the continued growth and stability of the market. Technology's embrace. Modernizing the Indian exchange. Technology played a transformative role in the Indian stock market. The introduction of dematerialization, or DMAT, in 1996 was a game changer. DMAT eliminated physical share certificates. The move to electronic trading and DMAT accounts made the market more efficient. It reduced the risk of fraud and errors. The introduction of the T+2 settlement cycle further enhanced market efficiency. The adoption of technology continued in the 21st century. Online trading platforms gained popularity. Mobile trading apps made it even easier for investors to participate in the market. Global tremors, riding out the dot-com bubble and 2008. The Indian stock market was not immune to global events. The dot-com bubble burst in the early 2000s, impacted markets worldwide. The Indian market experienced a correction. However, it recovered relatively quickly. The 2008 global financial crisis was a more severe test. The Indian market witnessed a sharp decline. The government and the Reserve Bank of India took swift measures. They introduced stimulus packages to support the economy. The Indian stock market demonstrated resilience during these global crises. The strong economic fundamentals of the country helped in the recovery. The market emerged stronger after each crisis. A new generation invests. Retail investors and the digital boom. The Indian stock market witnessed a surge in retail investor participation in the 2010s and 2020s. The digital revolution played a key role in this growth. Online trading platforms and mobile apps made investing more accessible. The increasing financial literacy among the Indian population also contributed to this trend. Investors recognized the potential of the stock market to generate long-term wealth. The growth of the mutual fund industry also attracted retail investors. Systematic investment plans, or SIPs, became a popular way to invest in mutual funds. Weathering the storm. The market's resilience in the 2020s. The COVID-19 pandemic in 2020 brought unprecedented challenges. The Indian stock market witnessed a sharp decline as the pandemic spread. However, the market recovered quickly. This demonstrated its resilience. The government's efforts to support the economy played a role in the recovery. The Reserve Bank of India also took measures to maintain financial stability. The pandemic accelerated the adoption of technology in the stock market. Significant reforms, such as the Goods and Services Tax and the Insolvency and Bankruptcy Code, further strengthened the Indian economy. These reforms improved the ease of doing business. They attracted foreign investment. A pillar of growth, the Indian stock market today. The Indian stock market has come a long way since its inception. It has evolved into a sophisticated and resilient market. It is a major pillar of the Indian economy. The market reflects the country's economic growth. The Indian stock market is expected to continue its growth trajectory. The country's strong economic fundamentals, a growing middle class, and increasing financial literacy are positive factors. The Indian stock market is an attractive destination for investors. It offers significant growth opportunities. The market is well regulated and transparent. It provides a safe and secure environment for investors.